Good to see you.
Likewise.
So I actually wanted to just kind of focus on, did want to spend a little bit of time on, before we dive into what you're seeing through technicals, just kind of spend a bit of our time trying to understand technical analysis a little bit. So why does technical analysis work?
As we all know, there certainly are all types of trends throughout everything that we see in the universe, uptrends, downtrends, sideways trends. Using analysis that can help to understand these trends better certainly helps us all to take the blindfold off, to really understand how prices are moving and might be either coinciding with the movement that fundamentals suggest or maybe going opposite to what fundamentals suggest. Why does it work? That's an interesting question. I think that you can look at things in two ways. One is that you say, well, if everybody looks at charts, how can they work? Because everybody's looking at them. Well, price action patterns and cycles repeat over time. And so things certainly work a lot more often than what you would expect if everybody's looking at something to make it seem like it would never work. Things continue to work. A lot of that is due to energy. When price hits a certain level 1, 2, 3, 4 times, and all of a sudden it breaks through a level, that can give it a certain amount of energy that allows prices to trend in a way that fundamentals likely cannot explain. So it's that acceleration on breakouts and or the lack of acceleration and stochastic type movement in sideways ranges that I think technicals really help people to understand. In my view, one should always try to utilize technical analysis along with fundamentals to really understand how price is moving, depending on your time frame. Short term, intermediate term, long term, but they're useful on really any time frame to really helping you to understand what makes prices work. And it's rarely that the Federal Reserve or earnings or economic data will do justice in explaining the movement of prices. Prices always move in excess of what fundamental intrinsic value might suggest. If you think a stock is worth 30 and it goes above 30, do you want to sell it or not? If it's at 20, does that make it a buy? Well, maybe not. And so technicals can help you to, from a risk-reward perspective or from a period of speculation towards, helping you realize what the fundamentals suggest is a true value for whatever asset you're studying in the long run. I'm sorry, it's a very long-winded answer, but it's something that is important because, many people say, well, why would you want to use technicals if everybody's looking at them? They should never work, and they do. However, they don't always work. You can take that same argument and come to the opposite conclusion, whereas they should always work. And honestly, people make mistakes. Everybody's got a different time frame. They tend to use technicals differently. So it's all a question of risk management and how you choose to use these indicators to put the odds in your favor. And so the more things that you look at, the greater confluence or probability that what you're looking at likely can be correct, in my view. It helps to put the odds in your favor when you look at several different things versus one indicator, and you might or might not be correct. A lot of it depends on your time frame. So I'm having a tough time coming up with a short answer to a very interesting and a great question.
Yeah. No, I think that was a great answer. You said something in your answer about how you could use technicals for both short-term and long-term. I mean, I think this is generally true that I think there's sort of this perception that technicals are mostly for sort of short-term trading. It's used more, the legendary traders that we know use technicals, but the legendary long-term fundamental investors generally don't. So that's the perception. Why is that a misperception?
Well, at least in the United States, most people that aspire to be in portfolio management and to professionally run money are held to what's called the prudent man rule. And so it's commonly taught that most of your decisions should be based on fundamental analysis. And so technicals are very popular, I would argue, sometimes more popular in parts of Asia than they are in the US, where most fundamental portfolio managers are wed to the idea of making money for your clients, for your constituents, based on something that's easily understood or can be taught to investors as being the proper way to run money, which is basically buying something based on what something is worth, watching it appreciate over time and then selling it, looking at something that investors can understand, PE ratios or revenue acceleration or earnings guidance or balance sheet analysis, any one of those where you can understand where a company's finances are going. And so it makes sense as to why fundamental portfolio managers in the US use technical analysis. I would argue that particularly in this day and age with the influx of news, and we're all influenced by everything around us and what we hear, that it's really, really important to tune out all the news and try to eliminate emotion in decision making. And that's where technical analysis really can give one an edge. It can allow you to be more disciplined in managing money. Indicators like, for example, a 10-month moving average, where you have long-term trends at work, are very insightful and useful to technicians. You can see when price goes under a 10-month moving average and starts to decline. It would have given you advance warning on the entire bear markets from 2000 to 2003 and 2007 to 2009, even in 2021 to 2023, that this was happening, and as price was starting to roll over, that one would not be wise to buy the dips if you have a short-term time frame. So I think of it as very important, even for those with a longer-term time frame and strategy, just because it allows one to invest with the trends, and or if your time frame is short, to not to hold off in investing when the correlation really starts to rise rapidly and everything starts to roll over at once, and you might want to hold off on buying dips immediately. So no easy short answer for that.
And are there any asset classes where you wouldn't recommend using technicals for whatever reason?
No, technicals are simply a study of price action, so
Okay.
It all depends on one's time frame.
Okay.
If you find that something is not working because it goes sideways in a range for 5 months, it doesn't mean technicals aren't working. It just means you're in a sideways range. And cryptocurrencies are great for technicals of a shorter term duration because they tend to be very volatile and high beta and move a lot quicker than equities. So shorter term price action can probably help one to make returns a little bit easier in things that are more volatile. But technicals works across any asset class, I would argue.
So you mentioned, so it could be used in kind of all kinds of asset classes as long as we have prices, right?
Correct.
Quotable, studyable prices.
The more price action, the better.
Right.
Obviously, if you have a period of a week, then you can't make long-term analysis, but you can certainly identify an hourly range of how prices move. Sure.
Right. I actually want to go to, you mentioned, it could be used in crypto as well, obviously. I kind of want to use that as a case study. I believe it was back in January when we were together. You talked about how you predicted that Bitcoin was going to start correcting in February and through March, which is precisely what happened. What were you seeing? How did you get to that conclusion? I think that'll be a very helpful case study for our folks. And also, if I could just add to that, make it 2 case studies. You're also pretty timely on calling the most recent bottom. So what did you see then that would be, I think, helpful for this audience? And let me just quickly translate that.
My success at identifying Bitcoin's peak had more to do with cycles and counter trend analysis at the time than it did on pure trend following. Trends had been rising since September, and Bitcoin had doubled in price, and so many of my colleagues and peers continued to think that Bitcoin would continue to rise. I looked at a few different things, but I use cycles in my analysis. So a combination of DeMark analysis, which involves counter trend exhaustion signals. In other words, buying things in downtrends, selling things in uptrends. It helps to complement trend following methodology. So by use of DeMark, Elliott wave, and also cycles, one can find peaks and trends that then give way to weakness. Pure trend following technical analysis would not have told you that really until February, where it was very clear that Bitcoin had broken longer term trends and was starting to exert some downward momentum. I was fortunate in that these cycles worked in identifying peaks in mid-December very precisely, and also identified peaks in the spring for Bitcoin that would start to rise. I use those same cycles in equities, and most recently in April the 7th, and that's when Bitcoin and the S&P both bottomed on the same day, April the 7th. They both tend to have a very high degree of correlation still. It's just Bitcoin moves a lot more rapidly to the upside and downside. The answer is it's something I don't recommend for people that are new to technical analysis to try to go against trends. Trend following is the most important way to make money in markets, and it's generally thought to be wise to stick with trends until they end, as the saying goes. The trend is your friend until it ends. When you reach a certain level of proficiency in technicals, then you can use different tools besides just trend following logic, trend following indicators. So cycles, DeMark indicators, Elliott wave, those allow one to be able to identify when peaks and troughs can occur that can't be seen on just when trends are going up or down. Sentiment is probably one of the most underutilized but more effective tools that I use along with my methodology. When sentiment gets to extremes in both directions, it really helps when those line up with the cycles and different indicators that I use. So at the time of Bitcoin's peak, sentiment was extraordinarily bullish. I was getting notifications on my smartwatch that Bitcoin was at 100,000, and I said, that's funny. I laughed, and I said, the fact that everybody's talking about Bitcoin is going to go up, and there's a new administration, there are reasons to think that Bitcoin can face less deregulation, and that would be a positive for 2025, and there's so many bullish reasons at the time to think that Bitcoin was going to go up. Those started to be reflected in sentiment. And so I look at sentiment on Bitcoin and on stocks over time. And when things get very, very optimistic, you have to realize that we're close to a time when they might start to reverse. And I would say that was one of the things I utilize also for equities.
What are some of the sentiment indicators that folks here could look at to gauge sentiment?
Well, there's several that are important on a retail basis. One is AAII, the American Association for Individual Investors, which is a poll for about 85 retail people that is taken once a week. People ignore that because they think there isn't as big of a sample as you need, but it actually is very effective when it gets to extremes. So I use a combination of AAII along with looking at the equity put to call ratio. As a former options trader on the floor, we often use times when people were getting very negative on the market and buying downside puts and equities as being a time when markets could bottom out, being that put to call was very high, like it gets above 1 on an equity level, meaning there's an equal level of puts being bought as calls. That also happened a couple times in the last month. I utilize things like Fear and Greed Index by CNN is one. On an institutional level, the name exposure index, NAAIM, National Association of Investment Management Index. So that's a popular institutional poll. I look at CFTC data, Commodities Future Trading Commission. So they have, when they get to extremes on certain levels with regards to hedgers taking positions, it can be very insightful. And so I use that as well. I have about 10, honestly. So I look at a combination of these. I also utilize the Bank of America, the fund manager survey, FMS, that comes out once a month. And I find that to be very interesting as a contrarian tool. So when that shows, in the last 6 months, it showed really high level of exposure to Magnificent Seven stocks, to FANG. It became so-called a crowded trade. And that directly coincided with the time that it was peaking out. And so I like to track sentiment by many different methods. I say that for most people, keeping an eye on the equity put-to-call ratio is important, and a moving average of that, not just the actual day-to-day level, but moving averages along with AAII. You want to get a gauge of retail sentiment and institutional sentiment because they're both different. Retail has to be invested. They're a little bit negative, but they're still invested. The retail people are either all in or all out. And also the option activity you can sense when people start to become very speculative with buying call options on things or buying puts, and that's most easy to recognize. Retail are most easily susceptible to news flow and to getting bullish or bearish based on media, and that is really, really important. Right now, the media is very negative across the board. Any channel in the U.S. except for Fox is very much against the administration and is very negative on what's happening. And so that's important to notice because there are some positives. It's not all negative. The first 100 days has coincided with a lot of accomplishments, but certainly most of us would have handled tariffs differently in terms of the way things are going to try to reset the global order. And it's a high-risk strategy 1 year before the midterm elections. You don't have to translate all this. To answer your question, AII, fear and greed, equity put to call, name index. There are ones like Investors Intelligence Survey, Consensus, DSI, Daily Sentiment Index, which is done by a guy out of Chicago, and he does it for futures. And so DSI, when it reaches extremes, can be also helpful. So I use a combination. It's not one thing.
Yeah.
And it's listening to everybody around me who I speak with and friends who aren't in the market, who all of a sudden want to be in the market. Institutions, the media, they're all important. So tough question, not one answer. I use a combination of a bunch of things. Those are the ones I listed are the ones I probably use the most.
So you said that, obviously markets up 15% in 3 weeks, and there are a lot of people who I'm sure believe that this rally can't be real. What are technicals telling you now, near term and long term? Let me just do that.
I'll start off by saying, the reason or the things that coincided with the equity market bottoming on April the 7th had to do with excessive levels of fear. So sentiment was bearish. Volume showed signs of going from fear to capitulation, and that's an important difference and change. So we saw a rapid downside volume to the downside, followed by huge advanced decline to the upside that happened within a period of about 2 weeks, and it happened on a multiple of occasions where all the stocks were rising all at once. 95% or more of all stocks were rising on the day, and also volume for that matter. That was an important breadth signal. So breadth went from being washed out to really, really good very quickly. RSI went from being oversold, but I don't use RSI as a way of timing market peaks or troughs. It's more the divergences of RSI that are important. We were oversold. Breadth was very, very low, and then it became very good very quickly. Technology, to its credit, did not break down. We held longer term trend lines, and I look at relative charts of how tech looks versus the S&P. That got down to very good levels of support and started to show signs of turning higher. So it was a combination of the best part of the market underperformed in the near term, but didn't break down. So it held support. Meanwhile, breadth and momentum started to improve right near the lows at a time of massive pessimism and bearish sentiment. Those to me suggested like stocks could potentially bottom out. Also, my cycles bottomed in the early part of April and turned up. Where's the market going now? Let's concentrate on that. In the short run, if you're bullish, we're getting closer to a time when I feel we will probably stall out and have to consolidate gains. It doesn't mean one should be bearish. Again, a lot of this depends on your time frame. If you're a 3 to 5 day trader, then if you can sell the S&P at 5,800, then that's probably wise if you have a 2 to 3 week time frame. My own thinking is that the S&P peaks out between 5,750 and 5,800 as early as next week, but probably closer to the middle part of May, and sells off probably the last couple weeks of May into early June. June historically is a very bearish seasonal month. I am very optimistic about the progress that we've made off the lows. Sentiment continues to be negative, so I'm very bullish for the year, but I don't think it's going to be a straight line. I think we're going to have consolidation. That directly lines up with the fact that tariff negotiations are ongoing, and we don't still have a lot of clarity as to what's happening. So I think there's going to be more clarity probably within a month that will give us more evidence that, okay, now I see why stocks can move higher, because the U.S. can ink trade deals with Japan, with EU, with China potentially, and that would be a reason why markets could rise. Earnings have come in very good. I don't look at earnings, but they have come in better than expected. 77% of all companies have beaten earnings, and the average surprise has been about 8.5%, more than that, almost 9% of a surprise, which is greater than what they expected. Companies have not pulled back on AI spending and or CapEx, which has been good, looking at the earnings just yesterday and hopefully today as well. My thinking is that the S&P is going back to new all-time highs. It's going to get to 6650 is my target for the year. That's not going to be an easy thing to accomplish in the next couple months. It's going to take time. So we should be close to the first move up off the lows, meaning from April 7th, which I think probably ends sometime in May. And then we give way to a short-term correction, which could give back a third to maybe a half of all the progress that we've made of the 15% up, which means we probably could have a 5 to 8% correction, maybe a 10% correction, sometime in May into June. That's the time you want to buy. Sentiment continues to be negative. On any pullback would be the time to add risk. For those that want to hedge, the VIX has now dropped from 60 down to 22. It's quite attractive with regards to implied volatility. So looking at call spreads to take some exposure off the table from technology, put it into hedging mechanisms, put it into treasuries, put it into gold. Those are all still attractive. We can talk about that in a minute. Short and sweet answer, markets are still going up. Trends are bullish in the short run. I think that probably reaches some type of resistance. This is all very tough to do ahead of time. I usually address it as it occurs, so I'm doing this ahead of time. I think it's premature to expect a recession. As we head into next year, I have more concerns about the housing market, and if we don't rally sharply and reclaim that momentum, then that's going to be a problem probably from the fall into early 2026. Right now, I can't say that, but momentum is still negative on a weekly basis. It's really rolled over sharply. So we've had a good first move off the lows, and we're closing in on short-term overbought territory while weekly momentum is negative. Usually that's not a great combination. It means we probably need to consolidate. So it's been a great run. I still think sentiment is bearish and the market's push higher this year, but I think it's going to be a choppy 1 month.
Okay, that's a lot. You said that after we pull back sort of into June, if we don't, if the market doesn't kind of reclaim that momentum back up sharply into the year end, or therefore into the year end, that would be a worrying signal. So if that happens, like how worrying would that be? Like, is that just like a near term, like could that really signal something bad is on the horizon, just given everything that's going on, or is it just kind of mildly bad?
I don't think we can ever say that it's if we rally all the way back, that's certainly a healthy sign, but I would certainly be concerned if we don't see proper participation on the rally back to new highs.
And sorry, just to add to that question, clarify, meaning if we don't rally back, like could that potentially mean?
Yes, we could go into a larger bear market.
Yes. Okay.
Yeah.
Okay.
Meaning we could go down and test the lows and get under it, and we could have a bad time between October and next spring.
Got it.
I can't rule that out.
Right.
I think that we've had a lot of damage, but we've held where we needed to so far, but momentum has really taken a sharp, it's had a big decline. And now we've regained about 50% of that, more than that, very quickly. So that's a good sign. But there's more that needs to be done to have real confidence that we can go back to highs and everything's going to be great. And part of me is a little cautious about being as bullish about the years to come. I'm more positive about, can we get back to highs this year? And I think yes. But heading into next year, that's a subject for a different discussion.
Yeah.
I do have some worry about the real estate market starting to gradually roll over, and I think that's a problem that typically, historically has led to recessions. Rates have doubled since, they've gone in the U.S. from 3% to over 7% mortgages, and the housing has gotten largely unaffordable. The same thing is happening, I guess, in China. And I think that is, there's no easy answer. If the tariffs don't get immediately rolled back in a way that is, that's helpful, I think. I think the sentiment is very negative now, and I'm hopeful that the hard data does not roll over to join the soft data. Most of the polls remain negative. Companies are refusing to give forward guidance. People are making meaningful cutbacks. It's hard to ignore that. I try as a technician, but those are things that are in the back of my mind. There's certain unemployment, is the one thing we want to watch for. Today's jobless claims were at 244,000. That was materially higher. If we start to see people start to lay people off, that could be a problem. Right now, the economy is sound, but I, am worried that the years to come, you might see a little bit more volatility next year.
Right. So if we don't really rally back, it could be because some of the things that people worry about right now in terms of just fundamentals and policy and the economy, it could have actually, the fact that it didn't rally back and actually started to come down could imply that, or could signal that some of these worries have actually started to materialize.
I can't rule that out, and that's not my strong base case, and I'm not leading that we're heading into a recession or a bear market. I want to make that clear. Right now, I'm very concentrated on this year still being fine, but certainly a worry just based on my knowledge of cycles, and there are cycles that turn down in this year, that turn down into next year, and then turn back up. So I'm cognizant that this might be a process that is difficult to immediately get back to the highs and think everything is fine.
Just some of your highest conviction, maybe two or three, or one or two or three sort of highest conviction, bullish conviction calls from a sector or even asset class perspective outside of equities, from an asset class perspective, and also some of your highest conviction, bearish views.
I'm still quite bullish on precious metals. So I think gold it's at 3,200 now. I think it might get to 3,100, but I don't see much downside in gold from here. Trends and momentum are still quite bullish on an intermediate term basis. The Fed is in a rate cutting cycle, which could actually grow more pronounced with interest rates starting to roll over. I like buying this dip in gold. So hopeful that things like copper and silver can follow suit, and that would give me more optimism about long term, but I primarily want to stick with gold now. I think gold gets up to 3,750, 3,800 probably by this fall, and it could be between August and October. Historically, precious metals work very well in the fall period. So that appears to be one of the better risk-reward situations here outside of equities that I like from a bullish standpoint. I also like treasuries quite a bit. I think that my cycles for yields point down between April and August. And I think the 10-year probably gets down to 365, which is a big move down in yields. It's a great time to be long treasuries. For those that are concerned about the equity market, having some exposure in treasuries makes sense. That points to a potential weakening in the economy if yields fall that quickly, and I'm aware of that, but I still think that is a great place for investors to have money, is in the treasury market. I don't sense that yields are going back to the highs, at least this year. I think that's probably something that happens towards the back half of the year, potentially into next year, that might be a concern. But for the time being, my two biggest bets on the long side, outside of equities, would be gold and also buying treasuries. And the yen, for that matter, also. The dollar should follow suit to what is happening in yields, and we should see very good upward price action in euro, sterling, and also yen. So I think that we probably have a little bit further to go on the upside in Japanese yen. Dollar yen has bounced a little bit. We've seen some of the so-called haven trades reverse. So Swiss franc and the yen both pull back along with gold. I think that if gold works, then the yen should also work. And I think between now and the fall, we'll see the yen get down under 139, dollar yen, and probably mid 120s before it starts to turn back higher. On the bear side, I like being short crude oil. I think crude is going to go to $45, which is a big move. That also could be a sign of concern about lack of demand from China, about imports, about overproduction in the U.S. Saudi Arabia suggesting that they keep output at very high levels to punish the countries that have not paid attention to the quotas. All of those things suggest a supply-demand picture which favors much higher supply in the immediate future, and an administration that wants to see crude go lower for purposes of bringing inflation down. So that's a very important message, and Scott Bessent, the Treasury Secretary, said that last week. We want to get inflation down, we want to see crude fall. When he said that about interest rates, rates immediately, they have the power to do things to ramp up supply in ways it's going to make crude fall. So I'm very bearish on energy over the next 3 to 6 months. I think that crude is going to go down. I think energy falls. And if you want to be involved in energy, you have to do it by means of LNG or natural gas. Avoid fossil fuel energy, which should be going lower.
What was the crude to 45 potentially?
Yeah.
Okay, got it. And then the timing of the 10-year to 365?
Tricky, but
Just roughly. I think you said
August?
it, but I just missed it.
August is when my cycle's bottom. That would be a big move in a short period of time. Rates
Yeah.
are what, 410? So another
Yeah.
50 basis points in 10-year yields in the next 4 or 5 months, So yeah.
I think that's all the time we have. That's it.
Thank you very much, everybody.